Hi, welcome to week 3. We're going to be going over chapter 2, forecasting and budgeting. This week we're going to be learning about the purpose of budgets and forecasts. List and describe forecasting methods used by restaurants. Describe types of budgets. Identify the purpose of income statements. Describe how to prepare food and labor cost budgets. And explain the importance of variance and how it's used in operations. So we slightly went over what budgets and forecasts are. So forecasting uses historical information and knowledge of external factors to predict future results. These forecasts are used to build a budget. So we need to make sure we have accurate forecasting in order to build an accurate budget. A budget is a plan that indicates an operation's financial objectives or standards. Forecasting usually takes past numbers and builds in a certain additional percentage to account for growth. A budget is a plan that shows how managers expect to obtain and use resources to achieve the objectives of the business. Some advantages to budgets. They provide you with a control tool. It establishes that measurable target. It provides a common goal. Now, it's not just for you as a manager or other members of the management team, but also any level of employees in the restaurant. And also provides everybody with some accountability. Now, some disadvantages to budgets are the amount of time it takes to prepare and implement budgets is huge. There is hours, days, weeks. There is a lot of time involved. Now, not just time of you, but also support people. It could be other members in the restaurant or other members of the management team. It could also be accountants as well that you might hire outside to make sure you have everything taken care of. And then when you use that many people, you're compromising your confidentiality with so many people seeing all this information. On the forecasting process, there are two major forecasting methods that are used by restaurants. The percentage of sales method. It forecasts cost of sales and labor cost relative to expected revenue. There's also the simple markup method, which forecasts sales and expenses by adding the expected growth rate to last year's figures. So we'll go over the forecasting customer counts. All these examples that I'm using are also in the book as well. So we know the historical customer count plus the historical customer count times the percentage of estimated increase or decrease. So one of the examples they have in the book looks like they are taking an expected decrease of 4%. That's pretty huge. So you can see, you can do the math, the 32,300, and you're going to times that by 0.04, and you'll get the answer of 31,008. And then I did the math over here just as an increase in sales. Oh. And I'm missing a slide. I'm sorry. If you look on page 26, it also goes over the growth calculation. So here we did the percentage of sales. The next slide would have been going over the growth. So if you look at Exhibit 2.5, I think it's a little bit hard how they have that example there. So basically what they're saying is you need to look out for the inflation of your cost of goods. So everything's going to be going up. That's what they're estimating at 2.5%. So right off the top, you need to think about increasing all your cost of goods by 2.5%. Then also talks about increasing the 0.5% because that's what the customer demand is. So basically you're looking right off the top of increasing everything by 3%. I'm sorry. Excuse me. So in order to see real growth, you would need to increase by 3% instead. So now we're going to go into types of budgets. So we have long-term versus short-term budgets. So long-term is anywhere from 1 to 5 years. So I'm going to go down because that's usually kind of how budgets will go. You start off high and then you budget down lower, or shorter time from there. So there's two of them they talk about, and that one of them is the revenue budget, a budget that gives restaurants a financial direction. So you're just budgeting for what you think your revenue or your sales are going to be in the next 5 years. I mean, you would be breaking that up by year as well, year 1, 2, 3, 4, not just 5 years. Another important one is your capital expenditure budget. Now this budget allows restaurants to plan to replace your high cost equipment. So like your refrigerators, your stoves, any of those big items, because those are worth a whole lot of money and they're going to last for many, many years. Another one, which I had a boss call the Bible of the restaurant, is the operation budgets. And this is the most important. This will cover everything. It covers revenue and all costs that we haven't talked about, and a lot that we're not going to dig into too far in this class. It will include rent and taxes, utilities, license fee, your marketing, your repairs and maintenance, supplies, training, etc. It goes over every single thing that will ever cost the restaurant money. And then your short term is less than a year, usually in quarter, monthly, weekly, bi-weekly, daily. So these are just like little mini ops budgets just to keep everything in line. So the income statement, I like to think of it as a report card, how everything is going. So we did do one of these as an assignment last week, so we do know a little bit about it. It's actual monies being spent, actual spending and revenue data that are used to create income statements to prepare with the budgeted target numbers. Wow, weird, that kind of funky. As a review from last week, the difference between the two figures is a variance. The variance is caused by factors that are also outside of the manager's control, such as economic conditions, or stronger than expected demand. So its variances aren't always negative, they're positive. However, managers need to make effort to attempt to meet their target. You will need to adjust budgets to reflect what's really going on. So here is an example of the income statement. So if you look down, this is a lot more detailed than what we did in class. This brings more of the stuff that I was talking about and that you'll see in the budget as well. Yeah, a lot of the stuff we don't even touch on. So the reporting periods for when you want to do statements. There's no set rules. It's really just whatever works for you and the establishment. A few things you would like to think about that when you're making your periods. They usually align more with your budgets. You want to be able to have something to compare it to. Like I said, you don't want to be comparing apples and oranges. That doesn't work. You can't compare a daily to a monthly income statements in your budget. You're not getting any viable numbers. You're not getting accurate variances and stuff. So you want to make sure it's something that can align with your budget. Whether you don't do monthly counts, you still have either a 4 or 5 week process that will fit into a month or even into quarterlies. Periods can represent different data. So like the smaller, you have like daily reporting, weekly reporting. Those are going to be more of your prime cost items. And when you get into monthly or quarterly, you're going to be getting into a lot more of everything else on your statement, or more into your budgets and stuff. Collecting data takes a lot of time, especially when you're counting inventory. Weekly, monthly inventories, those could even be different. There's even daily inventories. It really just depends on how often you want to count, how accurate you want to be. If you're going to be doing the inventory, you always want to pick a day where inventory is low on slower days. Sundays and Mondays are usually establishment slower days. I've worked at a couple places where some gets done Sunday night by one person, another member of the management staff is there Monday morning and finishes it up. Now we're going to talk about the budgeting process. It's just how to go about developing a budget. There are 4 steps involved. We need to allocate the resources. Where is it all going to go? And then the effort made to keep as close to the budget as possible. What are you going to do in order to make sure you stay close? Then you're going to evaluate the results and then take any corrective action needed. It should be noted that budgeting is a continuous process. There is also an opportunity to explore several different courses of action and choose the one that will yield the best results for you. A lot of this stuff will come over in time. The more you do it, the more you're going to know what other actions you can do in order to get the results that you want. A lot of it is just trial and error. The most important thing about budgeting is that it causes one to think ahead. You have clear expectations to meet, measure performance, and to coordinate activities in the business so everyone works to maximize the outcomes. So step 1, the allocation of resources. In developing a budget, 3 key factors must be determined. What revenue will be from sales, what expenses will be from food, labor, and other expenses, what is desired profit. So once the budget is established, resources can be allocated according to the budget and manage these figures in mind. So when we talk about budgeting the revenue, this one's kind of tight. Unless it's a new business, the easiest way to do this is to use historical data. After reviewing this data, some assumptions about the future can be made, usually pulled from past experience or just by observing competition. This will help create sales forecasts using historical data and knowledge of external factors to predict future sales. Next, 3 sets of revenue projections should be made. You want conservative, moderate, and optimistic. We're always looking out for that optimistic side. Now these are set for the operations to set up different scenarios, such as good weeks, bad weeks, in terms of sales. For establishments, it is the best way to use conservative or the at worst case scenario approaches. So down here we have the sales forecast. So right here, as they call it here, I think so they call it 2 different things in the book. The weekly sales calculation, also the sales forecast. So you're taking the budget of what you have for 1 week and breaking it down into days according to, what you've seen in the restaurant, what your history has done. Or like I said, if it's a new restaurant, what's around you, what other people are doing. If you're opening a franchise, you also have, they have records of what they're projecting your sales to be as well. So when you're budgeting expenses, the food and beverage costs, there are 2 ways to estimate the cost. We've kind of talked about this earlier. The percentage of sales method. Now another example, if food sales forecasts are $10,000 for the week and the projections show an average of 34%. then the weekly food cost budget would be $3,400. And then the simple markup method, based on expenses being increased by a predetermined amount, normally a percentage from the previous year's expense. So you have an example. This year's food cost is excuse me, $280,000, and a 6% increase is projected. So you just do the math. That's an increase of $16,500. Add the two together. So now you have your predicted budget of $296,800. Now, when you're going to be budgeting labor costs should be predicted by position for each meal in a typical week based on the level of business expected. So you want to break it down depending on, how many meal periods you're doing. If you're doing all 3 meals, you're doing breakfast, lunch, dinner. If you're just a breakfast, lunch, or lunch and dinner restaurant. So you want to be able to predict for each one of those meal per position as well, not management and employee staff as well. One of the simplest ways to determine labor cost is to target labor as a percentage of sales. So if sales for the week is budgeted to be $10,000, then the target labor is 23%. You have $2,300 to spend on labor. Another way is to use service standard of the operation. Using this method, the average number of hours must be calculated for each day, as well as the average cost of labor per hour. Now, these numbers can calculate the average daily cost for labor for the next year. So a lot of those examples are over on page 41. Now, your other expenses, like your supplies, utilities, those also need to be budgeted for. Most variable expenses can be budgeted for using the percentage of sales method. They can also be estimated using the historical average plus the inflation method. Now, finally, the cost per customer method may be utilized where an average per customer for the last year is calculated and then used to predict next year's cost according to how many customers the establishment was expected to have. So when you're budgeting for profit, it's your most basic goal. You want to make a profit. One way to do this is to treat profit as cost, where revenue income minus required profit is your ideal expense. This is especially useful when the operation is looking for a specific return on investment. Now, since the required profit is already known, plans can be adjusted accordingly to increase revenue, decrease expenses, or even both. Now, how to calculate for a break-even point. The break-even point may also be used, which is the minimum amount of sales an establishment must generate to cover costs. Once this is known, an operation will be able to know how much it needs to cover all expenses for a given time period. And any additional income from this is profit. Now, step 2. Efforts are made to stay close to the plan as possible. Now, this is where it comes down to everybody knowing what the budget is, so everyone can stay on the same page. This includes all salaried employees and hourly workers. Simple as that. There's not much to do. Everyone just needs to know what is required of them and to follow up on that to make sure everyone's on the same, that they're where they need to be. Now, step 3 and 4, the results are evaluated or assessed, and we'll take any corrective action if necessary. In most businesses, some variance is normal and expected. However, large variances could be a call for corrective action, such as adjusting the budget, maybe it's an increase in sales, or controlling the actual spending. Now the difference between the actual results and the planned results is known as a variance. And I've drilled that into you guys a lot, but that's really important. We want to know that variance. This can be found by subtracting the budgeted data from the actual. Like I said before, they can be positive or negative, meaning above or below the budget numbers. The amount of the variance is often discussed in either dollars or as a percentage. For example, if a manager is budgeted $15,000 in sales, but the operation brought in only $12,000, so there would be an unfavorable minus $3,000 variance. And if you want to look at it as percentage-wise, that's a 20% variance. Now, the income statement should be reviewed regularly against the budgeted figures. You got to know where you are at all times in order to stay above water. If you're trending down, you need to know that you're trending down. So things to look for will include the large variances. That's why they're so important. That's going to tell you where you're doing bad or where you're doing great. When you're taking corrective action, when there's a problem with the budget, it's identified, corrective action may be taken to fix it. All right. So that could include altering the budget or making changes to the actual establishment. Such changes could be changing your food supplier to lower food costs, implementing staff training to help meet expectations, change payroll amounts so they will fall within budgeted amounts. You can also change your menu prices. They didn't talk about that. They also change your menu itself, where things are positioned in your menu. So, you know, your eyes go straight to the left-hand middle. That's where you're going to be selling the most of your stuff. So changing the layout of that will also help as well. And that's all I have for you guys today. There is also more I want you guys to be going over. We're going to go over it later on in the semester. I didn't want to talk about it now because this is a very hefty chapter, but if this is all making sense, make sure you go over, read the book. There's also shrinkage and AP, EP weights. If you can get familiar with that now, that'll just give you a head start, but I didn't talk about that now because we'll be going over again, and like I said, this is a pretty hefty chapter. Please email me with any questions, comments, curses, anything. I want to make sure I'm getting you guys where you need to be. Thank you and have a wonderful week.